Good afternoon, folks. So this week you can see I'm in a really pleasant place with a whole lot of longwood shola forests behind me and tea estates around me. So from this, I hope I have pleasant news. But then a lot of things that have happened in the US overnight tend to be concerning the global markets quite a bit. So the big, beautiful bill that Trump was speaking of finally got passed by the Congress. And as soon as it was passed, Ray Dalio, the famed chief of Bridgewater, took to social media with his concerns. So he says that the new bill is going to be leading to spending of at least $7 trillion, up from $5 trillion now. Okay, and with debt going up by $7.5 trillion, we almost go from 5 times revenue to 7.5 times revenue. Okay, and from 100% debt to GDP to about 130% debt to GDP. And this is not good for the US bond market because the confidence of investors in US treasuries is likely to come down because of this. Okay, so how does one really deal with such a situation? From the US government's point of view, they would probably want to devalue and debase the currency to make it easier to repay. You see, the repayments would almost go up to $18 trillion principal and interest put together in a few years' time. And if $18 trillion are the kind of repayments, then a lot of other social welfare spending and important, probably other productive spending will have to be cut down. That is going to be an economic loss. Okay? And also, if the US government has to make this viable by devaluing the dollar or by reducing interest rates to unimaginably low levels, this is not at all good for the US bond market. And if it's not good for the US bond market, Ray Dalio says it's not good for anybody in the world. So it's rather an ominous warning that the way the US government is going to borrow heavily for unproductive spending is not a good sign. Of course, the Treasury Secretary Scott Bessent has a completely different view. He says because of this bill, growth will pick up from 1.8% to at least 2.8% or so, which was the rate of growth during Trump's first term. And he says this higher economic growth will make up for the additional interest that the government will have to be paying. Well, those are the different kind of viewpoints that are there. But all in all, it doesn't bode well for the US treasuries now. And mixed with all this, the latest job report that has come out from the US points to a stronger employment instead of a weaker employment. So you see, the market was hoping that if there was weaker employment, you're bound to have some Fed rate cuts happening. And that doesn't look like it's going to happen because of the stronger employment report that has come in. And the 10-year yield has come down to 4.36%. Okay? So let's see what happens going forward. And then there was a nice article from Devina Mehra in the Mint. And here she speaks about investors getting confused between asset classes. One has to take a view from a top-down approach. First decide on the kind of asset classes one has to invest in before trying to figure out which particular investment wants to go in. And she in particular speaks about the kind of confusing questions that could come up from distributors or advisors or investors. For example, some of the questions could be like this, she says. Is it better to invest in a PMS that invests in equity or an AIF with a great derivative strategy? Or equity mutual fund SIPs are outdated and recommends a global gold ETF. So what do you think? So these are kind of confusions that could arise because gold and equity are completely different asset classes. A PMS and a derivative strategy are completely different strategies. So one should not get confused with these and rather first decide on what is the asset allocation one desires. How much bond, how much equity, how much commodities do you want before one figures out what kind of structure to invest in. The structure is the last thing that you would want to do. Those are the nuts and bolts of the machine. First figure out how do you want to build the machine? What is the machine that you want that's going to take you where you want to be? One could also look at diversifying geographically. Okay, how much do you want in India, your home country? How much do you want in the US, the largest economy in the world? How much do you want in emerging markets, which are now, which is definitely an asset class to be looking at as far as equities or even bonds are concerned? So these are the more important questions investors should be asking themselves or asking the advisor before trying to figure out which structure and how to do it. You see, whether it's an AIF or a PMS or a mutual fund, they're all structures through which you invest into an underlying asset class. Okay? So my advice to all of you also would be the same thing. First, figure out your asset allocation before trying to figure out where do you want to invest. Okay, so these are the things that I'd like to leave you this week with. Have a great weekend ahead.